What's up, guys? Welcome back. Another episode of the Average Muddy Podcast. In this episode, talking about something that's not exactly sexy and fun to talk about at parties and probably won't get you too many friends, but it's super important inside personal finance and the things that you're doing to better your personal finance situation, and that is credit score. JJ and I are going to talk about ways to improve it. Is it important? Do you really need it? Ways to fix it? All the things that really encompass the credit score and how it affects our personal finance. If you don't know who I am, my name is Brad Finn, and I am joined tonight, as always, with my good buddy JJ Buckner. JJ, how you doing, bud?
I'm good, man. Tonight, I am drinking a good old Busch Light apple. For those of you that have not had one of these yet, I think they actually may have just discontinued them. So if you see them in your grocery store or a gas station or whatever, I highly recommend you pick some up because they are tasty.
What's the JJ Buckner rating score on that beer?
Oh, nice. Dude, I honestly like.
Has it made it to a video yet?
It hasn't, but it's coming. So you guys get the first rating on this. They're good. They're tasty. They're not too sweet. You can drink probably like 4 or 5 of them till you kind of get tired of them. I give them like an 8.4.
Is it a cider?
No, I don't think so. It just tastes good, man.
I was telling you before, I don't know. I have never even heard of that. And if it's already discontinued, I got a good old-fashioned red, white, and blue here, bud.
What is that? What's a red, white, and blue?
I am the Budweiser beer.
Oh, nice.
Yeah.
Represent STL.
You know, I do. And also, it's
my hometown, by the way.
Well, you live in the suburbs. That's like me saying I'm from New York City. You're from the burbs.
That's true. I'm south of the suburbs.
All right, we're already putting people to sleep. And there goes our retention time. Yeah. So tonight, JJ, we've been talking about it, and we were like, should we even have this episode? Are people going to want to listen? And it's just one of those things where it's important, and if we're going to be those guys that have been learning and helping our own situations, and our mission is to help others, even if it's not the most exciting or you're not going to laugh the most, it's still information that we want people to hear. And I think the best place for us to start, is a credit score even necessary and important? Because as somebody that's been through the full spectrum of getting out of debt and listening to people and reading other books, and not to mention any names specifically, which we might, but do we even need a credit score?
Yeah, that's a great question. And like you mentioned, there are so many different viewpoints on this. Is credit good? How should you build your credit? What is it for? What the hell even is credit? So, and again, we will touch on all of that today, but basically like what I like to think of credit in layman's terms. Credit is basically a report card on how well you handle your money. Plain and simple. So if you are, if you're making your payments on time, your credit score is going to be higher. If you're not going into foreclosures, your car is not getting repossessed, your credit score is going to be higher. So basically, if you can handle your money well, your credit score is relatively going to be higher. Now, there's things that Brad and I are going to touch on in today's episode that there's ways to make that credit score even higher than what it is. If you're starting from scratch, let's say you don't have any credit at all, there's ways that we'll touch on in today's episode of basically just to keep your credit score where it's at. Let's say you're at a 760 or above. There's ways that you could drop that down that you don't want to do. So we're going to touch on all of that in today's episode. And like Brad mentioned, this may not be the most exciting topic, but it's something that a lot of people really need to understand because down the road, it could really help you out. And it could end up saving you thousands and thousands of dollars when you go to get loans on a mortgage for your property or whatever that may be.
Yeah, and so how do we feel? What's our first position on, the other side of the argument that says all debt score is, or all a credit score is how good you are at paying off debt? And as both of us advocate, we are against debt. So how can we be against debt, but then advocate for a program that tells us how good we are at paying off debt? If you know what I'm saying?
No, yeah, man, that's a tricky one, to be honest. But really, my opinion on that is you have to have a credit score. I mean, everything revolves around credit nowadays, even your insurance. If you have a higher credit score, your insurance is going to be cheaper. So, I mean, little things like that people don't think about is what's so important of having a credit score. it's a lot harder to get a mortgage when you don't have a credit score. There's a lot more loopholes you have to jump through. So, my opinion is yes, I think credit is very important. I think you need to have a credit score to hold throughout life. What are your thoughts on that, Brad?
I think that you mentioned the mortgage, and the mortgage is something that's definitely comes up. But I don't know. You own a property and you rent. I know when I rented, they checked my credit score. So I think when people hear first glance that it's good for your mortgage, and it's not even make or break getting a mortgage or not getting a mortgage. We'll talk a little bit about the difference in 5% and 4% on an interest rate, but do you check your tenant's credit score as well? Because when I rented, they checked my credit score.
Yes, I do.
So I mean, that's even for somebody that's not really necessarily ready to buy a house. There's ways, and the money saving aspect is huge, and it's not something that's in the front of my mind because when we take out a mortgage, and most of us are going to take out mortgages, we don't understand how much money we're going to pay in interest. And sometimes on a 30-year mortgage, you might pay double for your house.
Or triple.
And the difference between 5 and 4% is really good. And I was told, and I used to believe, okay, well, I can get manual underwriting. I can get manual underwriting. And I think I know there's companies that do it and there's people that advocate for it. But when I was trying to do that, because I looked into it, I bought the house that I bought. I was a huge Dave Ramsey fan, and I looked into it. But what I found out was, yes, you can get your mortgage manually underwritten, but two things are going to happen that I found to be detrimental to that process for me. One of those was the time needed to do so. They won't take that manual underwriting process, and it's already a long time to get your mortgage approved. But when you're doing this manual underwriting, took a lot more time for me. And it's not even I wasn't patient, but it just took a long time. The other thing was you're taking away your advantage of being able to shop around. You're niching down the amount of companies that you could use to purchase a mortgage. And when you're buying a house, you should be going around and looking at all these different options that you have from different banks. And we keep mentioning mortgage, mortgage, mortgage because I don't think that I would ever advocate a good credit score to take on bad debt as far as, and we talked about good debt and bad debt in a previous episode, but like, I'm not saying I want to get a good credit score in a car. I'm going to buy all my cars cash. And I want to be very, very clear about that. So I think when we use the mortgage as an example over and over again, I think that's just the major life purchase that I know coming into our later stages of life where it's going to save you a ton of money to have a good credit score.
Yeah, and I think sometimes also that I wanted to touch on something you said, like kept taking a long time for your manual underwriting to go through is right now with our current market we're in, if you have to have a 60-day closing date because your manual underwriting is going to go through, you may miss out on all the deals because you have to be very competitive in today's market. And if you got to wait 60 days or however long it takes for a manual underwriting process to go through, you're probably most likely your deal's not going to look as nice as other deals that are out there. And I know from buying either a rental property or a personal mortgage or a personal like primary home, there's going to be most likely multiple offers if you're buying a home right now.
Oh, talk to your friend that's a real estate agent and ask him how many houses are even making it to that open house. Because the house next door to me just sold before open. You are so right. And when you watch these cliche like $1 million listing shows, whenever they're negotiating, they're always saying like all cash 30-day close, or they're always shortening that close time. And like I said, I'm not downing manual underwriting. Like I said, I'm not saying that it's bad. I'm just giving both sides of the fence and showing you from my personal experience when I tried to get it. I went to Wells Fargo, who I currently have my mortgage with, and they were like, we'll be able to get it done in 30 days, where 60, 90 days was my alternative, and there wasn't even going to be a guarantee. And I was going to have to jump through a lot of hoops. Now, if you have time to jump through those hoops and having no credit score really means a lot to you, or if you're in a position where you don't necessarily have a credit score, and we'll talk about the differences between a bad credit score and no credit score. But yeah, it's a really big game changer.
This just made me think of something, and it's literally coming off the top of my head right now, and I want to get your thought on
You
this.
freestyling?
I am right now. So let's say there's a listener out there who has no ambitions to start real estate investing. Because I think, and we'll touch on that a little bit further into the episode, but I really think if you want to become a real estate investor or have any sort of property as an investment, a credit score is almost, I mean, it's almost a need, like you have to have it. Now, let's say there's a listener out there who is almost got their mortgage paid off. they have zero debt, and they have no thoughts of whatsoever being a real estate investor and ever borrowing money again. What do you say to that listener?
Say, yikes, man. Like, well, first, just like I'd give anybody advice, you do not know what is going to happen in 6 months. And the worst case scenario of having a good credit score is you at least give yourself more options and opportunities. And I feel like saying, I don't need a credit score, that's like being closed minded to me. And I used to be the guy that was like, I'm never going to I'm never going to be a real estate guy. That was
Mm-hmm.
me a year and a half ago. And now I want to go around and scoop up as much as I can.
Look at you now,
Oh,
Brad.
look at me
You
now.
got your big boy britches on, bud.
Feeling myself. And like I said, I'm buy, and I almost bought that lady's house next door. My wife's like, yo, can we pump the brakes? That's like right next door, bro. And it's not even that good of a deal. But no, you're absolutely right. And it's so true. And you don't know what's going to happen. And I feel like so many people want to eliminate their credit score just out of like to cut the nose to spite their face. Like I will
Right.
get and you talk to some loyalists from the DRAM crowd, myself included, that realize how much they shot themselves in the foot by, get cutting up their credit cards and closing those accounts. And we'll talk about how that's going to affect your credit score. But
Can I just give my 2 cents on this real quick?
yeah, go. Yeah, sure,
I
bro.
I basically would like to say, if I'm answering my own question here.
JJ, what would you say to a listener that was like, I don't think I'm ever going to get into credit. I don't think I'm never going to need that again.
Thank you, Brad. No, honestly, if I was that person in that situation, I would still keep my credit cards open for two reasons: to keep my credit score alive, but to also keep those rewards coming. And we're not going to get into rewards
We'll
on this
talk rewards
episode.
another day.
That's a whole dedicated episode. But those are two of the main reasons why I would keep my credit cards open, is to keep that credit score, because you never know what's going to happen in life. Brad, you said it perfect. Your life can change in 6 months. So I'm a fan of keeping that credit score alive, keep it up to date, keep it where it's at by having those credit cards open, and then obviously those rewards are a benefit as well.
And we'll talk about cutting them up, but I remember when I was getting out of debt, I did the old plastic surgery and I cut my credit cards up. And my wife was like, "What are you doing?" Like, we weren't a big credit card people. We weren't spending too much. We always we had like a JetBlue card and things like that. And I was like, "Nope." I was told we have to cut these credit cards up. And then my credit score went down and it probably affected my mortgage. But I remember when we got back into credit cards and I was like, "Tara, I think we're ready." And she's like, "We're ready. I told you not to cut them up in the first place." But it's also very different. And this is kind of the reason why we need to have this episode, is because when I met my wife at 22 years old, she had never owned a credit card. Where when I turned 18, my parents got me credit cards to, quote, start establishing me a credit score. And when I met my wife before getting out of debt and before all that, I had an 800 credit score and my wife didn't have anything. And she was much better, quote, with money than I was. But one of the things we're going to talk about is the term that you're holding cards for. And that's why you pay your debts off, you pay your credit cards off, but you might want to leave those accounts open. And I think we can start to talk about like how are we building it. So now we've established, okay, it's probably a good idea to have a credit score, JJ. I think it would be hard for us to argue against it. I think that's one thing that we can definitely agree on. So now you have somebody that's in a position where they have a little bit of credit, they may have a credit score, but they've never really looked, and they see all the commercials for check your credit scores for free and this, that, and the other thing. What are steps that people should be taking now if they want to start to think about it? Like, is it same as everything else where don't worry about having the 800. Let's worry about having it go up a little bit at a time, and maybe some of the factors that affect what that score is. What's a high score? What's a low score? What's a good score? And then, yeah, I'm curious your take, because I know that we both started with different opinions on what was important on building credit and not so much.
Yeah, so first, to answer your question on like what's a good score, what's a bad score, I love what you said about saying just focus on growing it. Check it every check it every month or so, or every 3 months, whatever you're comfortable doing.
At least every
And
quarter, at least every quarter.
yes, exactly. And there's ways you can do that. Like, for example, I bank with Capital One. They have CreditWise, I believe it's what it's called, and you can check it whenever you want. It gives you an updated score. It quickly reads your credit rating, and it can show you what your new credit score is. So I love that feature with Capital One. Now, as far as factors of credit, so there's really 5 ways that your credit score is made up. So I'm gonna run through these real quick, and then Brad, feel free to chime in on anything if you hear something that you want to talk about. But the first one I wanted to touch on was on-time payment history. So basically, it's exactly what it says. It's how often, when you've had debt or when you have credit cards you have to pay, how often are you making those payments on time? Now, this is the most important criteria or factor of your credit score because it makes up 35% of your score.
So there's different
That's the
factors are going to affect it in different ways, is what you're saying.
correct. Yep, and there's a different percentages that gets applied to your score, this one being the highest. So if you get anything out of today's episode, it's pay your bills on time, and your credit score will be that much better. So, obviously, there's a history. Everyone has one. Stuff's going to happen. Maybe you've missed some payments. Maybe you've got a car repossessed, or maybe you missed a couple mortgage payments, whatever that may be. I would say try to make a goal right now to never, ever miss a payment again. I can sit here and I'm going to do a little humble flex on you guys real quick. And I'm not trying to come off conceited, but I got to say this is because it's possible. Since I've been 18 years old, I have never missed a payment in my life, ever. So that's one of the reasons why my credit score is where it's at. So with your on-time payment, it's basically just so important to never miss a payment. And I cannot say that enough. I may be repeating myself, but it's so important.
And an easy way to do that, and a way that I've adopted. And there's two things I want to say about paying off paying it off on time. First, I'll say that generally most companies will have a grace period of like 2 to 3 days. So if your payment's due on the 8th, don't freak out and think you're a loser. Get it paid on the 8th, but if it usually have a day or two. The other thing is, and I just made a video about this, was the power of automation. Like, I have all my credit cards set pay full balance every Wednesday. And the reason I do it weekly is because I know I'm not going to add up too much in the course of a week, and because I know it's always set. And I want to just touch upon, because you just said, the importance of checking it every quarter, not even just to flex on your score, but also to detect any fraud or anything that's going on and people using your credit too. I wanted to, before I forgot, because it was in the front of my brain, I diverged a little bit there, but you're checking your score not just to see what your score is, but also to protect your identity as well. But yeah, no, definitely pay. I've missed some payments. I can't flex on that. I've missed payments before, mostly because I was ignorant to the situation and didn't understand how much it really affected things. I'm like, what's a couple days? They're going to get their money. Who cares? I'm going to pay a little bit of interest, but you don't realize how that's going to affect this quote score. So you're absolutely right, bud. Pay on time and try and use automation. I think that, do you use automation or no?
No, I do everything on my own. I take that back. There are a couple bills I have that are automated, like my cell phone bill and my trash bill. I think are my two main ones that I have automatically come out. But everything else, I just pay I pay myself. I don't know why I do that. It's just something
It's become a routine for you. Know
It
thyself.
has.
Know thyself, right? It just
Exactly. One of the most important things.
And I know people like to pay it themselves because they like to review it every week.
That's probably one of the reasons why I do it. So the next one here for factors of credit. So this is the second highest one on a percentage rating. This one is your credit utilization. So your credit utilization is basically how much of your credit that you have available. Let's say you have $100,000 in credit available. The less you're using of that, the higher your score is going to be. So the important thing to keep in mind here is to don't max out your credit cards. If you let's say you have 3 different credit cards, you got a Chase card, you have a Home Depot card, and you have a ladies, you got a what's a ladies card? A JC
Victoria's
Penney?
Secret,
Hell, I don't.
Victoria's Secret, bro.
Victoria's Secret.
Yeah.
There you go. That's a good one.
Men, you might shop there too. I was speaking, in general.
Yes.
I was generalizing.
Yes.
Yep.
So Victoria's Secret card. That's a good one. So you don't want to. Let's say you have those 3 cards. You don't want to run a maximum balance on all those because that's going to lower your credit score because that's showing the banks or whoever's checking your credit that you don't have much credit available because they're all maxed up. They're bills that need to be paid. So if you can, here's another one of the most important things on this podcast. on this episode, and I will probably say it again today, is please, please, please always pay your credit cards in full. Never pay a monthly bill on your credit card because you're going to be slaughtered
We talked
with the
about we
interest
talked
rate.
about it in debt.
Yes.
We talked about it. We talked about that in that debt episode about we're not putting credit cards on a pedestal for being bad. We're always putting the interest rate. And we
Correct.
will talk about the good and bad or the opinions of good and bad when it comes to credit cards. I don't want to go down that rabbit hole, but yes, don't give them any interest. Don't give them any.
Yes.
Now, I want you to talk about too, as you continue, and you can work this in. There's a fine line between keeping it at zero and actually using it, and then using that utilization. Is there a percentage that they kind of look for to stay under? Am I trying to stay under 10% utilization, 15%, or does that really not matter as long as you're paying it in full and you're getting rid of it and getting it close to zero maintaining a close to zero balance?
That's a good question. I can't answer that because if I would answer it, I don't know if I'd be telling you the 100% truth.
Okay.
So I don't know the exact percentage.
There might be one.
That there might be, and that may be something we could look in and maybe add in the show notes. But as an exact percentage of how much you should be using, to be honest, I think that may get a little stressful to be constantly worrying about, oh, am I going to hit over that percentage? To where basically, like you mentioned, if you're paying off those credit cards every single month, you're golden. I think that's really the biggest piece here is to make sure you're not maxing out those credit cards and paying them off every single month because that keeps that utilization down every month because you're paying that off. Now, another thing here is a quick little piece is ask for a higher credit available. Let's say your maximum on a credit card is $5,000 and you've owned this credit card for a couple years now. You've never missed a payment. Your income's maybe a little higher. Don't be afraid to call up your bank and say, "Hey guys, I think you could raise this up to 10 grand." And I guarantee you, if you show good credit history, they're going to raise it for you.
So that's like a little bit of a hack almost. You're saying that, every once in a while, call them and ask them because obviously if you have $1,000 limit and you have $100, that's 10% utilization. But if you have now a $500 limit and you're using the same $100 of credit, you just lowered your utilization a ton. So we should be calling up every once in a while, even if our goal isn't to ask for a higher balance so we can use a higher balance. Our goal is going to be to ask for a higher balance so that we can lower our credit utilization is what you're saying.
Yes. Exactly.
I got to do that tomorrow. I've never done that before.
Dude, it's awesome, man. And like every time I've called into the banks and asked to raise it, I've had no problem whatsoever. Even if it's just $1,000, that's $1,000 more dollars that gets added to your credit limit. That's going to it's going to raise your score.
Yeah, and it's going to lower your
utilization.
Oh wow. Okay. Yeah, I didn't really think about. I mean, not to say like I didn't think about it because I'm being reckless. I have an above 800 credit score. I have a good credit score, so I never thought about that. But no, that's something I could do for my wife because my wife has had credit cards now for a while. And like I said, she started late. So that's something for her. We've been paying off hers forever now. I could probably call and get hers up, and then that's probably going to boost her score.
There you go. You can pay me later, Brad.
Oh, man, see, we're helping each other now.
That's right,
we
dude.
Don't even
that's right.
We don't even need to post this. Thanks a lot.
Exactly.
Thanks a lot, JJ.
Buy me a beer later. So the next one on the list of factors of credit is the length of credit history. So this one makes up 15% of your score. And basically what this one is to get a credit card ASAP if you have not had one. This goes for new professionals. This goes for, you're newly 18 years old, you're a new adult, whatever it may be. It's very important to start that credit history as soon as you can. And with that, Brad, that leads me into our first sponsor for the Average Money Podcast by Jasper Card. So Jasper is a premium MasterCard designed for professionals who want to build great credit. This is a credit card that you can apply for with no credit history required as long as you have a proof of income, which is virtually impossible to get these days. You need a credit card to build credit efficiently, but most credit card companies won't approve you for a card unless you already have a credit history. Jasper is different because their unique underwriting is forward-looking. When you apply, they look at your potential instead of focusing just on your credit history. So maybe you just started a new job and you're heading in the right direction professionally, but you don't have much credit history built up yet. You can qualify for a Jasper card and have a real premium card now instead of starting out like many young people do with a debit card or a secured credit card. As long as you use your Jasper card responsibly, you'll build the good credit you need to rent that apartment you want or qualify for a mortgage down the road. Now, one more thing we love about Jasper is that their app is super easy to use and also comes with some great features such as a unique auto pay settings, push notifications, and utilization alerts that help you manage your account and build your credit. This card is perfect to help you start and continue to build your credit for you if you take the right steps. So, if you're interested, make sure you click the link in the show notes to apply for your Jasper card today.
Dude, it would have been something that I could have used when I was trying to get my wife credit, because you're one of the things you mentioned, and it's so true, and it's kind of like if you've ever applied for a job and they're like, well, you need 2 years of experience, and you're like, well, how do I get the
Yeah.
2 years of experience if no one will freaking hire me? And it's the same. And you mentioned, like, my wife and I, we had to go the traditional, like, get yourself a debit card, open up a
Yep.
bank account. And it's when you're 22 years old, or if you come to the country and you have great, past credit where you lived, and now you come to the United States, but you don't have any United States credit, and you're like, hey, I'm a businessman here. Or, hey, like, I did fine where I was, and now I'm just here. And everyone's like, no, it becomes very hard. And I think Jasper's a great opportunity. I'm glad that we learned about them and we know about them, and I'm even more pumped that we give the listeners the opportunity, because there's got to be somebody out there listening. One of you out there listening to us is in that situation where you've either tried to get one, or you can't get one, or you're young, and I think that's a great opportunity. Definitely, at worst comes to worst, if you're thinking about it, considering it, just take a look. Take a look and
Yeah.
see if it's for you. It might not be for you, but I think if you're looking to build credit and you're going to start to think about the things we're talking about in this episode, it's a power move.
I basically just want to say again, it's so important to get that credit history started. The sooner you can do that, the better off you're going to be. And the higher your credit score is going to be.
I'm living proof. I keep mentioning my wife,
Yep.
like 22 years old. She's 30 years old and she's still trying to build it, and that's somebody that was, quote, good with money, and she was just always saving money. And she comes from that background of, my credit score can be 0. But dude, when we got our first mortgage and she had like a 600 credit score, it made a pretty big difference, man. So
I can believe it.
yeah, so how are we going to start establishing credit? Like, when you say long-term history, we want to start to establish it early on in life, and we want to hold them. And there's certain credit cards that are better, I think, for holding long term. But I think we should definitely, I mean, you have some of those credit cards, and once again, we'll get to the rewards one day, but that have the annual fees and stuff. That might not be, but there are so many no fee credit cards that you can be using from a young age, that you can be using and keeping that utilization low, and you can be paying. There's plenty of opportunities to do that. I mean, how long do you hold on to a credit card for? I'm from the credit card churning game, so I haven't
Yeah.
had that many, but I know that I need to at least have 1 or 2 that I've had for a really long time.
Yeah. I have had my Chase cards since my wife and I have been married for 6 years. So we've had them for about 6 years now. And here's something else I want to mention, and then I got 2 more of these factors of credit I want to touch on. Is even when you're starting out, so maybe when you're 18, you don't know yourself yet financially. You don't know if you're a spender or a saver quite yet. You don't know if you get that credit card in your hands, you're like, ooh, I can go buy some new whatever you want, new headphones or a new Xbox, whatever it may be. So the cool thing about this is maybe you just use that credit card for your gas. Or maybe you use it for fast food when you're out with the boys or whatever it is. Like whenever I first started with my credit card at 18, my mom and dad said, okay, use this responsibly and use this to only fill up your gas tank. So I knew exactly where the card was in my wallet. And every time I was at the gas pump, I pulled that one card out and used it. And I knew to pay it off every single month. And doing that at 18 years old, which I thank my mom and dad every single day for this, is that helped out my credit history. That got me started right when I turned 18. So that's what's so important, and that's what I love about that Jasper card, to go back, is they're going to work with you if you're heading in the right direction.
Absolutely. And like you mentioned, their open-mindedness.
Yes.
They know that just because you don't have a credit score, you're not a dirtbag. Like,
Exactly.
they're going to give you a shot. If you show good, solid employment, and you show the ability to keep that utilization low and to be responsible and to pay it back, they're going to take a shot with you.
I love it. So the next factor on here for your credit score is your total credit lines, which is what we were kind of just talking about. So this makes up 10% of your score. So basically, what I mean by total credit lines is this may sound weird, but the more credit cards you have open and available to you, the higher your score is going to be. Now, I say that lightly. I'm not saying to go out and apply for 20 different cards.
You don't need to Graham Stephan this and have 45 credit.
Yeah,
The guy has a
exactly.
tote for his credit cards.
But seriously though, like let's say you've had your initial card you started out with at 18 or 22 or however old you were when you got your first credit card, maybe think about introducing a new credit card. And this doesn't have to be one with an annual fee. Just open up a Home Depot one or open up somewhere where you shop or go find a free credit card, maybe it's the Jasper card, whatever it may be. I think it's very important to have those multiple credit lines, whatever you feel comfortable with. If you don't feel comfortable having 10, don't have 10. If you feel comfortable having 2, just have 2 because you got to think about it. This is only 10% of your score. So it's not like this is like a make or break. You have to have 2 credit lines, but it definitely is important and it does have an effect on your score. So I think totally right now with my personal, not my business, I have, I think I only have 3 cards. So that's not a lot, and I still have a 800 credit score.
I have 3. I have 3. I have 3. I know exactly which ones I have 3. I have the Chase Hyatt, the Chase Sapphire Preferred, and the Capital One Venture. Those are the 3 that I have. And it low key helps that utilization too. So
Exactly.
like maybe what I'm gonna do, I'm gonna call up my wife's companies. Maybe I can't get a $5,000 limit, but I might, which is gonna change my
Go buy another one or go get another one.
that's not gonna change. That's gonna change my utilization, but I might be able to go get another one, and that will give me that 5,000, which will now open my, open and broaden the amount of credit that I have dispersed all over the place, and also lower my utilization.
Exactly.
This is almost like a little fun game, JJ.
It is, man. And the higher your credit score, the more money you save.
Now I see all these people like making videos on YouTube about how to get that 800 credit score, and it's like I didn't realize what a game this is. You might be getting me down a rabbit hole. I might get myself in trouble like trying to optimize my credit score. And I want to ask you a question, and maybe this is one of the last things. And if people are listening, you'll see JJ is a lot more versed on this than I am, which is I think why we love having these talks, because we always learn from each other. Is it true that there's really no difference between like an 800 and an 820? Like there's different ranges.
Yeah, so we're basically with the most important purchase you're going to make with your credit is your mortgage.
Right.
And every mortgage lender I've ever talked to, and I'll be honest with you guys, I talk to a shit ton of mortgage lenders. Because when I go to buy a property, if I'm not making 20 calls, I'm not working hard enough. And what I mean by that is when I go to look for a property or I'm getting pre-approved because I'm about ready to buy a new property, I will call and shop around for rates. And you can do this. I highly recommend you do this when you are buying your first home, your second home, a rental property, whatever it may be. Don't be afraid to call them and ask them to give you a roughly what their interest rate is going to be. And they don't have to take your credit score, by the way. You can get a rough around the edges interest rate if you just say, oh yeah, I know my credit score is above 760 because that's their mark. That's like their cutoff. If you have a credit score above 760, you're going to get that's like top tier for mortgage lenders.
Okay.
So if you can get above that 760 mark, you're in like the golden range. And then if you just tell them you're above that, they'll give you an interest rate without even having to check your credit.
Let me ask you this about the shopping around. I've heard both sides of the fence on this. Is it true that shopping around, you're not going to get multiple? Because I know when you get your credit score checked, what they call it, like a hit or something, like an inquiry. If you get an inquiry on your credit score,
a hard inquiry,
it lowers your credit score for a temporary amount of time. If I'm going around shopping around, is that going to dominate my credit score with all these inquiries that I'm getting?
Yeah, so that's a very good question. So if you are shopping around for a mortgage and you're going to be getting a lot of, let's say they are taking your credit score history and they're checking your credit, all of these mortgage lenders that you're talking to.
Okay.
The cool thing about this is when you are shopping for a mortgage or whatever it may be, and you do get multiple hard inquiries on your credit, a hard inquiry is the one that will lower your credit score. A soft inquiry does not affect your credit score. I just want to make that known real quick. So when you have a hard inquiry on your credit when you're shopping for a mortgage, the cool part is you have around 14 to 45 days. There's a range in there depending on where you live at and kind of how all that works. But 14 to 45 days, roughly, is what they say, is how much time you have to get all of these different hard inquiries on your credit for your mortgage interest rate.
Wow. So that's almost, I guess, to protect you. That's almost good that they're doing that because they kind of want you to shop around.
Yes.
Like, when I say they, whoever the big bad they is, but they want to give you the opportunity. Because I was always told, like, find the bank, do your research, and go to that bank because you don't want to get too many inquiries. Where in fact, I might have been told wrong information. And I guess if you're curious about it, I guess when you go to that bank, be like, hey, I've gotten a hard inquiry. Is it true that? And they'll know better than anybody what the state law or what the specific laws are for those, and they can give you the full information right there, right?
Yes. Yeah. And all those hard inquiries just end up being just one on your credit. So you may get, let's say you get 5 different hard inquiries on your credit within a 14-day span for your mortgage. All of those hard inquiries will only be used one time on your credit score. Now, here's another cool part. Don't be afraid to negotiate with other mortgage lenders. Now, I know we're kind of getting off topic
Nah,
here,
keep
but I want
going.
to make this
No,
point.
I was just gonna say, put another one in the column for something Brad learned tonight. Multiple hard inquiries in a short amount of time do not count as. Keep going. Give me more. Give me more.
Yeah, so I mean, just don't be afraid to negotiate. So when you're talking to these multiple lenders, when you find like your bottom 3 lenders who have the lowest interest rate, and I do this all the time, I always call them back and say, "Hey guys, listen, here's what I got going on. I got, Joe Schmo over here is giving me a 3.25. I got Johnny Appleseed giving me a 3.5, and then I got whoever else, Professor X, I don't know, giving me a 3.875, whatever.
And then there's Batman. What is
I'm
Batman? What
Batman.
is Batman giving you?
But so you got these 3 different scores. Don't be afraid to go to the second lowest guy and say, "Hey, can you beat this?"
It's not a set fast equation that they're
No,
just boop 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 and it spits out a number. There's a range of negotiation, is what you're saying.
there is. It's slight, but there is a range.
Love it. And but slight, and people don't understand. And this goes both ways, but like a slight difference can make a very very big difference. I wish I had a
Hell yes, it
calculator
can.
up, and you guys can look at it. But like very simple. Like say the average mortgage is $250,000 in the United States of America. I don't know what it is. I'm from New York, so if I start talking numbers, everyone's going to tell me what a donkey I am. But if you take that and multiply it by 0.042, which would be a 4.2% interest rate, and see how much the interest on that would be, it's going to be much different. Like amortization tables, one of the worst thing I did was ever make an amortization table on my Google Sheet. But the difference between, looking that up, and maybe JJ, if you have your computer up, and maybe you can do that, if you look at like a 30-year mortgage, the difference between 4.2 and 4, and the difference between 4 and 3.8, which is, it's on paper, they're going to preach it as, oh, it's only 0.2%. Well, it's going to be a really big one.
All right, you ready for this? Okay, so I have 3 scenarios here, all $250,000 purchase price. I have a 3.5 interest rate, I have a 2.75, and I have a 3.25. So if you calculate all of those out, it's going to be. So here, I'll do 2 scenarios. I'll do the highest versus the lowest.
Yeah, I've had a beer or two. You go to 3, you're gonna lose me. But keep them close. Like yeah, and mortgage rates. You call people. What's an average rate right now? Like what's a good and what's a great rate?
I would say a great right now is probably like 2.75. A good's 3.25 maybe.
Okay, so that's a 0.5% difference.
Yeah. So on a 30-year loan for a 2.75, you're going to be paying an interest about $117,000 to $118,000.
Okay,
And then on a 3.25% loan, you're going to be paying around $142,000.
so $30,000 difference.
Yeah.
$1,000 a year
Yeah.
for a 0.5%. And
Yes.
and from your experience, how much is credit score going to affect that 0.5%? I think I saw that. I think like because I had a buddy that was a mortgage broker, and he was like, well, your wife's credit score is killing you, bro. And I'm like,
Mhm.
what do you mean? Like, do I have to like divorce her? Like, is it bad? Is it bad? Give it to me straight, doc. Like, what's going to happen here? And he's like, I know you're a numbers guy. Just, just take I got you the best interest rate I can get you, but don't talk to your friends. Don't ask them what they got, and definitely don't plug it into a calculator.
It's smart, man. No, I mean it's true. It's very important to. And here's I guess another little note too is you could like let's say you're a married let's say this. Let's say you're in Brad's position. Let's say you have pretty decent credit, but your spouse doesn't. Now you could actually, if you can still qualify for the loan, you may be better off just applying for the loan yourself and not even having your spouse on as a co-borrower. That could help you out. Now I would still try to raise her or his credit up in the meantime, but that's something to think about. If you could still apply for the loan on your income and get it approved, you may be better off just using your higher credit score and not even having your co-borrower, and it's less paperwork you have to worry about as well.
And your broker will help you with that. I saw that with my first
Yes.
business, and my partner, he didn't have any credit. He didn't have bad credit. He had no credit. And when we were taking out a loan with the company, the bank was pretty much just like, Brad, or they said, I don't want to mention my partner's name, but they said, it would be best if we just use Brad's.
Mhm.
And a little bit of writing in a business, you say, okay, I'm taking on the loan, but we're going to split it 50-50, but you're absolutely right. Yeah. Sometimes it's better to leave them off.
Yes. Yeah, no, for sure. So the last factor of your credit here, and then we can kind of wrap this up, Brad. And we kind of really touched on this already, but it was the total hard inquiries. That's about 10% of your score. So however many times you're applying for more credit, whether that be let's say you go to apply for a mortgage and then you go to apply for a new car loan, which I don't advise doing. I say buy your cars in cash.
Amen.
But then on the same week, you're also applying for a mortgage or a new credit card, and you got all those three cases. Those are all three hard inquiries on your credit. So the total hard inquiries you're going to have, the more you have in a year, that's obviously the more it's going to affect your credit score. Now, it only makes up about 10%, but again, just be wary of how many times you're hitting your credit on a hard inquiry, because the more you do it, the more your credit score is going to dip down.
My buddy has a my buddy's in a situation right now where he needs a new car, and he's not from my blood, so he's definitely going to be financing that car, and he also needs a house. And he's like, my mortgage broker keeps telling me, do not buy a car because I do not need any hard inquiries
Right,
on your
right.
record when you're going to go. And he's been waiting, and he's been waiting, and like I said, selfishly, I'll give full transparency. This episode was pretty much JJ teaching me a couple things about credit, and I think it would be helpful and selfish of me again to. Can you just recap those again? What those
Yes.
things were? Because we talked about them in detail. So just to wrap them up, and also to give some advice to somebody that might be feeling overwhelmed. Like, there's so much to think about, and there's definitely places where we should start, and we should just, as we mentioned early on in this episode, just start to build it a little bit and learn and keep building it. So what's the recap, and what are we telling people that they should probably start doing to just start to change their credit score? Don't think about raising it, or don't think about getting it to perfect. Changing
Yeah,
it for the
I
better.
love that.
Change it for the
I,
better.
I want to start first with what I would be telling people to do to either raise their credit or just even start a credit history or to start their credit score. My first piece of advice would be to open a credit card. Open a credit card if you know yourself that you're not going to overspend. Now, if you're a spender and if you have a credit card to your name and you just can't do it, don't do that. There's other ways you can do to build credit. But I would first just say open a credit card and slowly and make those payments in full every single month. Never hold a balance, never carry a balance on a month-to-month basis, just pay it off in full. And if you do that slowly, and I also like the tip I gave earlier in the episode about you maybe use it for just one purchased item. Maybe you use it every time you run through McDonald's to grab a coffee or a sandwich or whatever, or you use it every time you get gas or whatever it may be. If you know that that card is specifically for that purchase, whatever that is, gas, McDonald's, whatever, I think that sets you up better. But if you know you can put all your purchases on the credit card, then you're fine. Just do that and pay off the end of the month, and you're all right. That's going to raise your credit score. But basically, to run through these factors again, On-time payment history, that's the number one. That's 35% of your score. People just do not miss a payment. If you don't miss a payment, you're going to be 35% ahead on raising your credit score every single month. Next one is credit utilization. The less credit you're using on a month-to-month basis, the better off you're going to be. We kind of talked about, raising your balance a little bit, maybe getting a new credit card, whatever that may be. So the next one is the length of credit history. If you're a younger individual listening to this podcast, I recommend getting a credit card right away, because the longer you have that credit history, the better off you're going to be down the road when you're mine and Brad's age, buying your first home, first investment property, whatever that may be. The next one is total credit lines. Let's say you've had this first credit card for a while now. Maybe it's time to venture out and get a second one, because that's going to show you have more credit lines set up. So when you go to get a loan on a property or whatever it may be, that's going to raise your credit score because you got the total credit lines available, more credit lines available. And then the last one is a total hard inquiries. We just finished up with that. Just be wary of how many times you're hitting your credit on a hard basis.
I want to just add to that and kind of like wrap it up with, and I'm going to speak for you. We totally advocate using credit cards responsibly. And we have both been firm believers in Dave Ramsey, which we know is going to be the opposite spectrum of what we're talking about tonight. My YouTube channel started as Baby Steps Brad. I have been there, but I'm also telling you from personal experience that the reason that this podcast, and I'm saying it like all jokes aside, like serious Brad coming out, here's teacher voice. I'm telling you this because it is going to change your life financially if you have a good credit score at some point. Whether you are renting, whether you are going to buy a mortgage, it is going to make your life better. And I have lost money. My net worth is less because I tried to stay closed-minded and I tried to focus on, no debt. Debt is bad. Debt is bad. Debt is bad. When debt is bad, debt is terrible, but credit cards and credit scores are not terrible.
I love it. And by the way, you're still Baby Steps Brad in my phone.
The Baby Steps Brad days were good, and I don't dislike Dave Ramsey. I have a more open mind.
No, I love Dave Ramsey. Honestly, he's one guy I would love to meet. I would love to shake his hand because he's the whole reason why I'm doing what I'm doing today.
He gets a thank you from me, but I've realized now 3 years later, and that's why I sympathize. I sympathize with people that, and I sympathize in that debt episode. I sympathize when people say there's no such thing as good debt, and then they shut their brains off. I sympathize, and I sympathize that this is the devil's plastic, and I can't believe we're talking about credit cards and credit scores. And I know we'll probably get roasted when we do a rewards episode one day about credit card rewards, but I think there's enough people out there that at least have an open mind and at least know us from a genuine level and know that we're not just making this episode to fill time or to waste your commute. These are things that we really, really feel strongly that the average person can do on a regular day-to-day basis, whether they are 18 or 70 or 80 or 100. Good for you. 100's a good run. And I think that at the end of the day, when you see it, you're either going to see it for the good and you're going to get a lower interest rate and you're going to save yourself $40,000 on that average mortgage. And you're going to be like, okay, I'm glad I had an open mind. I tried it out. Or you're going to be like me and you're going to go in and you're going to try and get a mortgage and you're going to realize what your interest rate could have been. And then just like most things, when you're greedy and you don't really listen and you're stubborn, stubbornness never gets you anywhere.
And I also want to reiterate too, if there is a very small flicker in your brain that you have even the thought that you might get into real estate investing in your future, you want to start your credit history as soon as possible. The higher credit score you're going to have, the more money you're going to save, the better deals you get whenever you're borrowing money for a investment property. And let me tell you this, the interest rates are a shit ton higher whenever you're looking for an investment property versus a personal primary residence.
Amen, brother. And we'll wrap it up. I'll say to everybody, thank you so much for listening. You got something you want to say, JJ? Go ahead. No, go. I'll edit that out and go again.
No, go ahead and wrap it up. I got the review I want to read.
Okay. Yeah, man, I think it is an important episode. Like I said, thank you for sticking with us. Guys, we appreciate this. Is going to be coming out probably around episode 5 or so. And we are just enjoying this more and more every single day. If you've noticed, we started putting the full episodes onto YouTube. You guys have asked for them. We're going to start putting them there. We are here for you. And, you can go check those out there on YouTube. Also, we have an Instagram page. If you want to see some photos and what we got going on, and I think JJ is coming to New York one of these days, so you'll get to see what we're doing. So you can follow us over there on the Average Money Podcast, Twitter as well, Average Money. And you can listen to these full episodes in audio, the major players, whatever you're listening to, on Spotify, on Google, on Apple, all the places that you can listen to podcasts, guys. And I really appreciate it. JJ, you got anything else before we get out of here, bud?
Yeah, basically, I just want to reiterate that, guys, leaving a review, especially for a newer podcast like us. I mean, this is our, I don't even remember, 5th or 6th episode, something like that. I mean, we're not showing up anywhere yet, but what really helps us out, guys, is if you leave us a review. When you leave us a review, honestly, if there's anything you can do to help us out with this podcast, it would just leave us a review. I actually got a review here I want to read from a longtime follower of both Brad and I's, Dollar Blazing. She left a review, and I'm going to start doing this at the end of every episode. I want to, just for a quick shout out, I want to give you guys some love and feedback on your reviews you're leaving us. So Dollar Blazing says, "These guys are amazing. I've been viewing their YouTube channels since the beginning. Watching them grow has been not only a pleasure, but highly informative. Their content has not only helped me on my financial journey, but inspired me to create content myself. I know you will love this podcast." Dollar Blazing, thank you so much for that review. Honestly, I love seeing that, Brad. Like, don't you love seeing your community that you started from YouTube? Now they're coming over to the podcast. I mean, this is just, honestly, it's a dream come true. It's a dream come true to be able to talk about something I'm so passionate about and have people like Dollar Blazing to kind of join in on that community with us.
She, I think, was probably like my 25th subscriber.
I love it.
Last summer, she came and stayed at my house. She was like, "I'm coming to New York. I'm coming." I said, you got a bed, you got a room, you got whatever. We went to the beach. She is great people. And yes, like you said, constant support, feedback. And there's a laundry list of others just like them. And we are sincere and we thank you guys so much. We hope you enjoyed this time. We're going to keep going, bud, right? We are not stopping. We have some more guests lined up. We have some good times. I hope you enjoyed this episode, guys, and we'll see you on the next one.